At 8:17 on a Tuesday morning, Elena opens her banking app and sees a message that makes no sense. Transfers are delayed. Her paycheck landed yesterday. Her rent leaves tomorrow. And the number on the screen, the number she
Whoa.
thought was safely hers, suddenly feels less like money and more like a promise. Elena is 29, works in payroll for a small furniture company, and keeps checking her phone between emails. She has 3 months of rent, a worn-out laptop, and the kind of savings goal that lives in a spreadsheet, enough for a deposit on a better apartment. But now, her group chat is exploding. Someone has posted a screenshot from a news site. Someone else says their transfer failed. Then a coworker writes the sentence that turns vague concern into panic. Should we take our money out? That question is how a bank run starts. Not with a villain twirling a mustache, not necessarily with an empty vault. It starts when ordinary people stop believing they will be the last person paid. Elena's bank is fictional, but the mechanism is very real. Banks make a simple deal with people like her. Put your money here, and you can use it whenever you need it. In return, the bank does not leave every dollar sitting in a drawer waiting for Elena to buy groceries. It keeps some money ready for withdrawals and uses much of the rest to make loans or buy assets such as government bonds. It is how banking supports mortgages, car loans, payroll, and business expansion. Elena's deposit helps fund somebody else's kitchen renovation, a bakery's new oven, or a student's tuition payment. The bank earns interest from borrowers and pays Elena a smaller amount for keeping her money there. Normally, this works because people do not all need their money at exactly the same moment. Elena gets paid on Friday. Her landlord gets paid on the 1st. A restaurant pays suppliers next week.
The bank does not need every dollar in cash every morning because most mornings, nobody asks for every dollar. Then comes the bad headline. It says the bank owns long-term bonds that have fallen in market value after interest rates rose quickly. She thinks of bonds as the boring part of finance, the financial equivalent of beige paint. But suddenly, beige paint is on fire. A bond is basically an IOU. When governments or companies borrow money, they may issue bonds and promise payments over time. Older bonds can look less attractive when new bonds begin paying higher interest. If Elena owns a bond that pays 2%, while new bonds pay 5%, few buyers will pay full price for hers. Its market value falls. If the bank can wait until the bond matures, it may still receive the promised payments. The problem appears when the bank cannot wait. Its customers are demanding cash now. The app says deposits are insured up to a limit. Her balance is below that limit. She knows, at least in theory, that protection exists for exactly this sort of moment. But theory has a strange weakness. It does not stop your thumb from hovering over the transfer button. Her friend Marcus calls from a delivery van. He has a small online clothing business on the side, and his account holds money for fabric, packaging, and his part-time assistant. "I'm moving it," he says. Not because I know something, because everyone else is moving it. That sentence contains the entire nightmare. Marcus does not need proof that the bank will fail. He only needs to believe that other people may run first. If he waits and they are wrong, he loses nothing but a few minutes. If he waits and they are right, he could lose access to money his business needs today. From Marcus's point of view, leaving first can feel rational. From the bank's point of view, thousands of rational individual choices become a stampede. This is the ugly geometry of a bank run. A bank can be solvent, meaning its assets may be worth more than what it owes over time, and still face a liquidity crisis, meaning it lacks ready cash right now. Solvency asks, can you eventually pay your bills? Liquidity asks, can you pay them this afternoon? Those are different questions. In calm weather, the difference sounds technical. In a panic, it decides whether Elena can pay rent. But it cannot instantly turn every loan into cash without consequences. You cannot walk into a homeowner's kitchen, point at their mortgage, and demand that they somehow repay 30 years today. You cannot sell a large pile of assets quickly without accepting whatever price frightened buyers offer. So the bank starts selling bonds. Because interest rates rose, it sells some for less than it paid. What had been a paper loss becomes a real loss. That sale worries more customers. More customers request withdrawals. The bank must sell more assets. Each action meant to meet panic can feed the next round of panic. The app does not show balance sheets or bond durations. It shows a spinning wheel. She tries to send money to another account and gets a notice. Your transfer is being reviewed. Her stomach drops. By lunch, people are sharing photos of a line outside a branch across town. The line itself becomes news, and news about the line creates another line. Nobody in that queue has to understand bank accounting. They only need to understand the social rule of a fire drill. If everybody is heading for the exit, you do not want to be the person calmly asking whether there is really smoke. This is why confidence is not some soft, decorative extra in banking. It is part of the machinery. A bank's promise is not merely that it has assets somewhere. It is that customers can access money when they need it. Once that promise becomes doubtful, the fear can create the failure it predicts. People often hear this and conclude that banks should keep every deposit as cash. It sounds comforting. Elena would probably agree at 1:06 that afternoon. But a bank that locked every dollar in cash could not make most loans. Credit would become scarcer and likely more expensive. Businesses would have less funding to grow. Families would find mortgages harder to get. The modern economy chose a trade-off. Money can be available on demand for depositors, while much of it is also working elsewhere. That trade-off makes useful lending possible, but it also makes trust essential. The system builds guardrails around that weakness. Deposit insurance is one. It tells small depositors that if an insured bank fails, they are protected up to a stated limit, so they have less reason to sprint for the door. Supervision is another. Regulators examine whether banks have enough capital, meaning a buffer funded by owners and retained earnings that can absorb losses. They also watch liquidity, the resources a bank can use quickly. Central banks can act as lenders of last resort, lending against good collateral when a healthy bank faces a sudden cash shortage. The point is not to reward careless managers. It is to stop a sudden rush for cash from wrecking the lives of people who never caused the original mistake. By late afternoon, regulators take control of the bank. The wording is formal. Operations will continue, covered depositors will be protected, and officials will work to preserve stability. Elena reads it twice. First, she feels relief, then anger. She worked, saved, avoided expensive debt, and built an emergency fund. Yet for several hours, her rent depended on decisions made by strangers about bonds she had never seen. The next morning, Elena can use her account. Her rent clears. Her coffee tastes unusually good because panic makes ordinary routines feel luxurious. Marcus gets enough access to pay his assistant, but loses a week calling suppliers and explaining delays. Elena's company changes banks and spreads its cash around. A banking panic never stays inside a bank. It becomes a delayed wage, a missed delivery, a canceled order, a landlord waiting for rent. The giant number in a headline is really a chain of small promises between people. And that is the lesson Elena keeps. A bank run is not simply people taking their own money back. It is what happens when everyone tries to turn a shared promise into immediate cash at the same time. The promise may be sound over years and still break under a rush. That is why trust, insurance, and boring risk management matter. Elena did not lose her rent money, but she lost the easy assumption that a balance on a screen is identical to cash in her hand. Most days, that assumption works. On the rare day it does not, an entire financial system races to make it true again. She also learns that the safest sounding question is not always, "Is my bank good?" but "What happens if everyone needs cash before the bank has time?" That is a question about the system, not one company. Because the real product a bank sells is time. Confidence that your money will be there when your life needs it. If this made bank runs finally make sense, subscribe, like the video, and tell us in the comments which economic mystery we should unpack next.